Good evening, TheoTrade. This is Corey Rosenblumen. You're watching the Theo nightly video for the 30th of December here in the last couple days of 2020, which means, of course, the new year begins Friday. So let's take a look at the performance of the market in terms of the S&P at least. We're up off that little earlier start to the year, and of course, so we're going to define looking back on our performance, and we can do that all this weekend and look at the lessons learned and how can we get ready to start 2021 with a fresh perspective and ready to get back in the trading arena with profits. So I think 2020 is going to be defined, of course, as the pandemic year and this initial crash. One of the big lessons about that is markets that are overbought do have high risk of pulling back. And sometimes that pullback is very sharp and violent and volatile. No, it is certainly not possible, at least as of December or November, probably even January, to predict the market was going to fall this sharply because of a global pandemic. But risk of fall or risk of drop, sudden drop, increases as the market keeps going higher. So that's something we can always take into account. But 2020 was a good year to discuss that. So overbought markets can stay overbought, but something, some catalyst somewhere, somehow, something gives risk to a sharp, sudden drop. And the pandemic was that catalyst that got the market really lots and lots of stocks, essentially sent us into a bear market very, very quickly. But on the other side, a big lesson to learn was the stimulus, and both from Congress and from the Fed, the interventionary policies, the stimulus checks, and all the other components that went into boosting the economy wiped it all away, at least in terms of the stock market. So while news was bad about recessions and jobless unemployment benefits and claims and all the different things about companies going bankrupt or restaurants shutting down, travel reaching all-time lows, etc., market didn't seem to be phased, at least not to the extent that stimulus helped boost up the equity prices and papered over, covered over, obscured, assisted, whatever word you want to use. The grand theme about 2020 is going to be not only the crash, but the recovery. And that's a good note to end the year on. We're going to end the year 2020 at all-time highs, just a little bit shy of them, but just about for the S&P and the Nasdaq. The technology sector, that includes the monsters of tech, that was even stronger. One of the themes of 2020 will be the dominance of the monsters of tech. And that includes, I like to check on them this way, on a grid, that's Facebook, Amazon, Netflix is in there, Apple, and Google, just to name a few. We also included this year Tesla. Where can I take a stock off this chart? We'll take Tesla off and put in Tesla. And that stock, if I count the numbers correctly, is up about 600%. And that's just a car company that's taken the market share of about the fifth or sixth largest company in the S&P 500. And it joined the S&P 500 and then subsequently the S&P 100 this year. So Tesla is one of those story stocks that was a gift that kept on giving the bulls but kept frustrating the downside of the bears. And here is the Tesla stock closing the year at 700 after a split. So split adjusted, that's even higher than that. And that's just a theme about 2020. It's just not only the earlier crash, which gave so much profit to those on the risk twist spread or in-out spread or any type of infinity spread or just any type of negative delta in the portfolio or hedged long-term portfolio. That was absolutely the correct thing to do and is the correct thing going into 2021. But the market recovered. So it's not all bearish, but it's not all bullish. The bulls got destroyed in the first 2 to 3 months of the year without hedges in terms of retirement accounts or anything that's a long equity portfolio. And if they bailed, panicked, sold, liquidated at the bottom of the market, that's a decision they're going to regret in 2020 and so on. So lessons about the market, it's big things can happen, but they can just as easily be corrected. And some stocks that are strong keep getting stronger. Anybody see Chipotle Mexican Grill, which was a typical restaurant retail stock? Now it's been in a strong uptrend on the bigger picture, just looking at the comparisons, but it sells burritos At TheoTrade, we like to joke that this is the overpriced burrito company. Overpriced at 400, overpriced at 600, overpriced at 800. And there's a coronavirus crash. Overpriced at 1,000, certainly. Overpriced at 1,200, overpriced at 1,400. And it's just that concept about Tesla or Bitcoin or some of these Nikolai and these energy voltage companies that just, here's just for reference, Neo is one of those stocks that went really from 0 to 50, or Nikolai, which all the way through the list, plenty of other examples, but worth discussing, went from this really 0 to 100 and then back to 0 just about. So these stocks are dangerous. They're not necessarily perfect little get-rich-quick schemes. It's better to be long-term and careful and cautious and about risk as opposed to how much money can I make? And if that's the thought process, just think about how quickly it went away. It was also the year, and we'll look at this broader perspective. As long as I've been trading 20 some odd years now, I don't think I ever thought oil could go to 0. I don't think I ever thought oil could go to $10 or 15 or 20, 35, something like that. I thought oil would be above 50 or 40 or some sort of bottom that would never ever be breached. But that wasn't the case in 2020, and this is after the March lockdowns and everything else. And the pandemic was just getting started, if you think of it that way, before the summertime. Crude oil, this front month contract went to 0. Actually, no, it went negative. The front month contract traded negative. And that was a surprise. But once again, as destructive as that was for the contract, right now it's going to end the year at 50. Not with the S&P at all-time highs, but still a very decent recovery given what happened in the economic circumstances that sent oil under 0, or the front month contract for that matter. And at this makes sense at least. This was bullish. We had some bullish trades and some bullish calls out in gold. And with the stimulus, I think this makes the most sense to me. If they're going to boost up the economy and create stimulus and quantitative easing and purchase bonds, and the government's going to send stimulus checks and all that, that's inflationary. So that makes sense that gold did what it did in terms of macro planning. And this was an inflationary play that got overheated. Like anything, even an inflationary defensive type of market can and does pull back. So that's the same logic about the equity market, or anything for that matter. That which is grossly, insanely, statistically impossible, it's better to go short. It's better to either avoid the market or fade it, because the next step in gold was not from 2,000 to 4,000, as maybe some people thought, not here at TheoTrade, but in the broader community. Gold is going to end the year at about the 1,900 print. That's down from 2,100, but certainly up from 1,550, where about the year started. So if the government is to provide stimulus in terms of stimulus checks and helping out the economy and helping out the citizens, the taxpayers, and the Fed's going to keep purchasing bonds and inflating the system and putting money in the system, it just makes sense logically that gold is going to be a beneficiary of that environment. But it got overheated. That logic worked, but it overshot. It was too correct, too accurate. So gold pulled back to a more fair value price at about 1,850 to 1,900. So we'll end 2020 with gold much higher than it was at the start, and the dollar, by the same logic, much lower than it was. And again, outside of equities, we don't go through this too much. We always talk about stocks in the market, but this is a broader macro theme that in a pandemic and a recession with terrible, terrible economic conditions, the government chose not to let it all fall apart, but to intervene, to give stimulus, to boost that economy, which makes sense. But so did the Federal Reserve. And in so doing, that helped devalue the dollar, which is inflationary, and also boost up the stock market and commodities in general across the board. So we as short-term traders, we do take hedged or spread type of positions, but it's always done in the backdrop of a bigger perspective and macroeconomic money flow. So we talk about that here as well. But these are bigger picture concepts with which to trade. And that's trading in the direction of the broader trend or fading against it, looking at leading stocks or looking at lagging stocks to trade in those directions. And with that, I always draw your attention, at least for a time, in the videos to strong stocks getting stronger, because they keep showing up, they keep getting stronger. So Tesla, in terms of today's session, 21 stocks made new, well, we can't call it all-time, in some cases all-time, but at least 52-week highs. That does include Tesla, Visa, Walt Disney, Starbucks, the caffeine company, coffee company, and HP, and down the list. So again, we just talked about Tesla, but Starbucks joined the list. 2020 was a stressful year, so it makes sense that retail coffee name Starbucks, was a top leader at the end of the year. It might not make as much sense that Tesla was, but nonetheless, there it is. A car company, not a coffee company, a car company, is going to end the year in the S&P 100 as the best performer. And before we end the video, and we end this particular conversation about the reflective, or what to do about 2021, this is a helpful tool, or at least a helpful column you can put into a watch list. It's the yearly relative range. And that's just inside of a customized list, and there it is, yearly relative range. And what that does is takes the current price and puts it into a percentage of where it is over that yearly range. So if it says 100, that means, or close to 100, that means Tesla is at the all-time high for the year. So Booking would be another example. There's Starbucks at the top of its range, which is 98%, almost there, but see, it came off at the high, just technicalities. Johnson & Johnson, a little top there, not quite the top, but at the prior high. Disney, of course, we discussed it. That's one that might not make sense either. With movies and theaters shut down, the parks in Orlando and Anaheim, California shut down, nobody can go to Disney, well, for the most of the year. Disney will close the year at the high, and that's a pretty significant high for Disney. So things don't always have to make sense. Of course, Goldman Sachs, Visa, and some other Morgan Stanley financial companies, that's maybe makes sense, maybe it doesn't, but the trends are there, the price is there, the strong stocks are there. That which is strong does tend to get stronger. So we're going to end the year once again at the high. And this is not the first time we've seen this. We'll go back in time as we continue thinking about 2021 and this concept of bullish holiday drift. So back into 2019, drift. I think January will be a little more drift, but we start to see the risk increase for a steep pullback. Like the coronavirus crash? I hope not, but at least some type of volatile event. And therein lies where we are at the end of the year. Additional bullish holiday drift, continued uptrend, but as each new high gets made, the risk of a pullback and a more violent pullback gets stronger. So continue watching your positions, your portfolio, any spreads or any open positions you have into the new year, and understand that this drift may continue, but each day that it does, it's one more day at risk of a steep correction. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for December 30th, 2020.